Hey, everybody. This is Peter Hafner, certified financial planner and certified financial fiduciary. And I want to ask you a question this morning. I'm wondering, when you're looking at your investments, when you're looking at your portfolios, do you ever feel like the market is rigged? Because you know what? If it is rigged, it's rigged in your favor. And you know what I mean by this? Take a look at this chart. This chart is just incredible. What it shows us is 60 years of stock market cycles. And we've always heard the stock market is cyclical, right? It's a cycle. There's boom and there's bust. There's good market and bad market. The good are called bull markets and the bad are called bear markets. And that's what this chart here shows us. It shows us 60 years of the cycles between bull and bear markets. And I just want you to look at this. And what do you have to notice about this chart? What do you see when you look at the relationship between the blue and the orange, the good and the bad, the bull and the bear? It's unmistakable. It's undeniable. The market is up so much more often than it's down. And I think people just don't really realize this. And even when the market's down, look at how short a period of time it's down for compared to the long periods of time that it's running upwards. So, what I want you to understand is the market's not rigged, but really the market works in your favor if you understand this relationship between the good markets and the bad. And in fact, if we look at the averages since 1963, what we see is that the average good market lasts 51 months and the average bad market only lasts a little less than a year, 11.1 months. The average good market is up 151%, while the average bad market is down 34.2%. So, what I want you to understand is there is no free lunch. Investing, it's simple, but it's not easy. And it's not easy because when things are down, we get scared and we feel like we have to do something. We're hardwired that when we feel fear, we feel like we need to act. That's what saved us throughout history, right? From the saber-toothed tigers. If we saw a saber-toothed tiger, we'd run away and hide. That's what saved us, fight or flight. But that's why investing is so complicated, because the fight or flight mechanism that we're hardwired with works against us. Because generally speaking, when the bad markets come and they're down, we feel like we need to do something. And what can we possibly do? But for most people, it's sell. And that's, if you look at the charts and you look at how long the bad markets last, that's not going to work in your favor. The best thing to do is go against your instincts and your intuition and just stay put. So what I want you to do is I want you to understand that you too can get the really good returns that the stock market delivers, but you got to pay the price. There is no free lunch. And you know what that price is? The price is you got to ride out the downtime in the stock market. You got to ride through the bear markets and the downturns in the stock market. Now, there's a lot of other things going on. You got to have a diversified portfolio. Can't put all your money in Bitcoin and ride that out because that might not come back. But if you've got a diversified portfolio of index ETFs, for example, which is the way I like to do it, the indexes, they're going to go down, but they're going to come back up. The risk is not that the S&P 500 is going to go down and never come back again. The risk is that while it's down, you need to sell to raise cash flow, to raise money so you can live your life. And what you need to do, what you need to understand is when the markets are down, you got to pay the price. You got to stay put. You got to hold on to your investments and wait for the inevitable upturn to come in the stock market. And just take a look at this. The upturns are incredible. We had a bull market after the financial crisis of 2008, 2009. It was up 400% over the next few years. And when did it end? Well, it ended with COVID. And look at how short the COVID crash was. Yes, it went down 33%, but it didn't even last a year. It only lasted a few months, really. In fact, even though the market was down 33% in 2020, by the end of the year, the market was positive. So just remember, if you get worried about the market, remember this chart and just think to yourself, how can you possibly lose if you've got a diversified portfolio when this is the way the stock market acts? So hope you found this interesting. Hope you found it useful. Please share it with your friends and family if you did. And please click the subscribe button. And thank you for all of you who have been doing that. I really appreciate it. We're up over 100 subscribers now, and we're looking to get to 150 in the next few weeks. So that's it for today. Thanks for joining me, and I'll see you next time. Bye-bye.